Guys, Jared Wesley here of Live Traders and back for another weekly educational lecture. And this week's topic is no different than the last several topics, which means it's really important. I know I say that every week, but this week really is a very valuable lesson that you want to learn. Because when I first started trading, it's something that I took for granted. I didn't look at often enough, and it cost me a lot of money when I was new. And that topic is multiple time frame analysis. I'm getting lots of emails from folks and questions in the chat room and on YouTube, etc., about certain trade ideas that people are putting out there. And perhaps the idea they show me is not that bad on a 2-minute chart, on a 5-minute chart, on a 15-minute chart even. However, the higher time frame is garbage, or they're going directly against the market, etc., and so forth. What I'm saying is many of you guys out there are doing what I call trading in a vacuum. Okay, you're not looking around you. And I say this in today's lecture that you're going to see. But what I'm talking simply about, guys, to give you an analogy, is that you are in a forest, okay, and you are in a tree, and you're looking at the bark, and you're looking at the branch, and you're looking at the leaves of the tree. That's the 1-minute, the 2-minute, the 5-minute chart. But what you're not seeing is the entire forest. So everything around you could be catching on fire, and you won't know it because you're so narrow-minded and so narrow-mindedly focused that you can't see what's actually happening right in front of you, next to you, behind you, etc. Okay, so we call this multiple time frame analysis. Way too many of you are taking these 2-minute, 5-minute entries without looking at the 60-minute chart, without looking at the daily chart. You swing traders out there, you're taking these daily entries without looking at the weekly or the monthly chart. So in today's lecture, which is about an hour long, guys, I dig deep into multiple time frame analysis. It will be one of the more important topics you ever hear. Obviously, money management is always number one. It supersedes everything. Okay, but multiple time frame analysis up in that top 3 things that you need to learn to be a successful, profitable trader. So please don't overlook it. Just so you know, the video starts out talking about different styles of trading, like intraday trading, swing trading, and core trading. But about 10 minutes into it, I really dig deep into multiple time frame analysis, guys. Okay, so please, you'll see I list all the reasons why it's important there. Please pay attention, because if you don't, it's going to cost you money. I see it happen every single day. People email me, go, Jared, why did this trade fail? It looks like a perfect 3-bar play. And then I show them the higher time frame, and they nod their head and go, I didn't look at that. Obviously. So here at Live Traders, we call it a top-down approach. We start with the higher time frame and we work backwards down to the lower time frame. So higher time frame bias, higher, lower, neutral, and then we drill down for a lower time frame entry. Okay, I took a few slides out of professional trading strategies to help you guys along. Yes, you're welcome. Okay, so please enjoy the lecture. And guys, you can also get a $1 30-day trial to the Live Traders chat room. See, I see some of you guys commenting on certain videos like, oh yeah, that's a great slide. Why don't you show it in real time live? Come into the chat room, guys. In fact, I'll put the NVIDIA trade I took today up there, all right? I took that live in front of several hundred people today in the chat room. So you can come into the chat room for $1 for a 30-day trial if you're a new member. So I don't want to hear any of that garbage about how this is hindsight stuff, okay? So enjoy the multiple time frame analysis lecture, and I'll see you guys again next week. Jared Wesley of Live Traders signing off. All right, guys, so today's topic is multiple time frame analysis, learning how to use all the data available to you, basically. And the reason I chose this topic is I think it's been happening for a long time, but just more recently, I've been seeing a lot of traders trading in a vacuum. And given the market's been so volatile lately, I think trading in a vacuum is even more dangerous than it normally is. And I understand, I get it. When I first started trading, I used to look at the 1-minute, 2-minute, 5-minute chart, and you get all enamored and all lathered up, and you're like, wow, what an incredible pattern, and not realizing you're going right into 60-minute resistance or right into daily resistance. So we're going to talk about that specific topic. I have about 10 or 15 charts that I want to look at with regard to multiple time frame analysis. But before we get to multiple time frame analysis, I want to talk just briefly, and I do mean briefly, 5-10 minutes tops, on just different trading time frames, because I know a lot of folks in the chat room don't say this, but occasionally they will. Every pattern that you learn, whether it's a 3-bar play, a breakout, a climactic, they're valid in all time frames. Climactic can happen on a 1-minute chart, it can happen on a yearly chart, and we're going to see that here in just a second. So before I get into the multiple time frame section, we're going to talk a little bit just about time frames in general for traders, so time frames and style. So again, I'm not going to spend a long time on this, but we try not to look at long-term, medium-term, and short-term because everything is relative to every trader. And as it says here, guys, to a scalper, a 60-minute chart would be considered long-term, but you're a scalper, so you're actually a short-term trader, okay? Whereas to a core trader, a 60-minute chart would be considered short-term. So we have conflicting. So I just like to refer to them as intraday trading, swing trading, and core trading. But the key here, guys, and this relates to multiple time frame analysis. This relates to multiple time frame analysis. Regardless of the time frame in which you trade, whether you're an intraday trader, whether you're a core trader, whether you're a swing trader, you should always be looking at least 2, 3 is better, but at least 2 time frames above and below your projected entry. Okay, so for example, if you're trading on a 15-minute chart, you should be looking at the 5-minute and the 2-minute. You should be looking at the 60-minute and the daily just to get a better idea, right? So you know the phrase seeing the forest from the trees? I mean, you could be on a tree branch and the forest around you could be burning down, but you have a microscope out and you're looking at the bark on a tiny little tree branch and you're looking at each individual leaf and you don't realize the whole tree you're on is on fire. And this is what I mean by giving that multiple time frame view. So in terms of general trading, intraday trading, swing trading, and core trading. If you're trading on 1 to 15-minute charts, you're an intraday trader. If you're trading on 60-minute charts or above, you're basically a swing trader. And if you're trading on weekly, monthly, and yearly charts, you are a core trader. This doesn't mean that you can't employ multiple styles and combine those styles from time to time. Okay? So again, quick, I'm not going to spend too much time on this. Intraday trader, you're looking to take advantage of small moves. You protect profits as the stock goes up, right? You're not looking to give too much back. Okay, now within intraday trading, you have micro scalpers, you have full-term day traders that hold for 4 or 5 hours. So there definitely are a lot of different variances in that. Swing trading, guys, you're basically looking for 2 to 10 day, 3 to 15 day moves. You're in most of those trades for 1 to 3 weeks most of the time. And then core trading, guys, is basically what most people consider or think about as investing, straight up investing, okay? So let me do this real quick, start that as well, just to have it. All right, so that's what most people think of as investing. So let's take a quick look. I'm gonna go through it very briefly, all right? Day trading, guys. Here is a 3 or 4 bar play. Wide bar breaks the support area. Okay. Narrow resting bar, and you're going to short this thing. Technically, it's a 3 bar play. I think that red bar triggered. But here's your entry. Here's your stop. And you're on a 5-minute chart. So you're at target in what? An hour or less here. 5, 10, 15, 20, 25, 30, 40 minutes you're at target on this thing. 40 minutes. That's a day trade. That's an intraday. And it's a short-term one. On a 15-minute chart, it's no different. Here's your gap up, you pull back, you get your bottoming tail, your entry's right over here at like 135, 136, your stop's at like 134.50, boom, it goes $5. But in this case, it's about an hour and a half. So not a huge difference here, 45 minutes versus an hour and a half, but that's an intraday trade. Different pattern, and guess what? If I erased the 15 off the chart, if I erased this at the bottom, you wouldn't know if that's a daily or not, right? Let's say I erased the price was on the right-hand side and I erased the time on the bottom. Would you know that that's not a monthly buy setup? Not likely. I mean, the gap would certainly help you out there, but you wouldn't really know, okay? Go to swing trading, all right? Here's a daily 3-bar play, right? You're breaking out of a stage 1 consolidation with a wide range igniting bar followed by a narrow range resting bar blast off. So instead of 45 minutes or an hour and a half, you're in this for 1, 2, 3, 4, 5 days, right? 5 days. Here's another daily chart, and it's a daily breakout. You buy it at $20, put your stop at 18, and you're in this 1, 2, 3, 4, 4 or 5 days,
Okay. Now, are these great examples of daily breakouts and 3-bar plays where they just work? Yes. Sometimes you're in a swing trade for 3 weeks. Okay. And on top of that, guys, we have core trades, monthly charts, yearly charts, even weekly charts, if you will. But here's a monthly breakout on a stock, right? You're getting in right around the $4 range. Your stop's around $3, and this thing rips to 80. Now, again, this is a very good example of a monthly core trade. But each one of these bars, every bar represents 1 month in time. So to get to this point, you're looking at 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17 months, almost a year and a half. This took almost a year and a half. Now, I think most of us would be happy to wait a year and a half to get like 20x on our money, right? We would, but it still took a year and a half. Here is a yearly chart of the Dow Jones Industrial Average, guys. This breakout, okay, right there is happening in the 1980s. So 30 to 40 years ago, and you'd still be in it today, right? So you're in basically around 1,000, Dow 1,000, and now we're at what? Dow 25, 26,000? 25x on your money in 40 years, okay? And here's just one more example that many of you guys have seen this chart. But you can see these patterns are happening on a yearly chart. There's a climactic sell set up, right, in the late 1920s. How long did it last? About 3 years, right? About 3 years. Okay, so when you take a look at this, these can be core trades. This Dow 1000 lasted 40 years. Maybe you would have gotten out over here, maybe, but it still would have been about a 25-year trade. 25-year trade. So why am I telling you all this before I get into multiple time frames? Okay, one, because you need to know that every pattern that is taught at Live Traders and in technical analysis in general is valid on all time frames. 1 minute chart up to yearly charts. Okay, I don't know anybody that uses more than yearly charts. 2, you can use technical analysis for anything. Everybody just assumes that technical analysis is only used for day traders. You know, that stigma, oh, you're a day trader? No. Technical analysis is no different than fundamental analysis when it comes to the time frames in which you can employ it or apply it to. Okay? So technical analysis is, again, this core trade right here is better than any fundamental trade you'll ever find in your entire lifetime, based off of a stinking chart. All right? So you had an entry at 1,000, stop loss at about 600, and 1,000 goes to 25,000 or 20,000. That's a pretty good return on your money. So I just want you guys to understand that technical charts can be used in any and all time frames. And if you want to employ a little bit of technical knowledge when you're using a monthly or yearly chart, that's fine. But don't ignore the chart. Don't ignore the chart. I won't, even in my long-term core portfolio, okay? I always look at yearly charts and monthly charts, even when I like the fundamentals of a company. All right, so let's move on, okay, to the topic of the day. Multiple time frame analysis. A little acronym MTFA. Guys, every time I do a lecture, I always say this is going to be one of the most important topics you're ever going to learn. This is actually one of the most important topics you're ever going to learn. If you combine multiple time frame analysis with good money management and decent trade management, you'll be a good trader, okay? So we never try to trade in a vacuum. You don't ever want to do that. We used the analogy a couple minutes ago about the forest from the trees, and too many traders get caught up at looking at the branch of the tree, the bark of a tree, the leaf of a tree, when they don't actually look at the whole tree. They don't look at the market in general and what's going on around them, okay? So this means we don't ever want to trade just one time frame. You trade one time frame, but you look at multiple time frames. Okay, so if you want to buy a 5-minute breakout, make sure you're looking at the 60-minute or the daily, and it's not into resistance. Okay, so why do we do this? And the next slide will help you understand this a little bit better. You're going to get more reliable entries by using the higher time frame as confirmation. What we talk about is a higher time frame bias right here with a lower time frame entry. They go hand in hand. Now, can you occasionally get away with vacuum trading? Yes, of course. Guys, bad trades work, good trades fail. But as a general rule, get used to, as intraday traders, get used to looking at the 60-minute chart, even when you're trading the 2 or the 5-minute. Okay, and for swing traders, if you're used to trading the daily chart, get used to looking at the weekly chart and the monthly chart. Get used to it. It will also help you guys if you drill down to a lower time frame, TF is time frame, to hop on a trending stock and get a better entry. I'm going to show you examples of this. Don't worry, okay? It will also help keep us out of a bad trade because the higher time frame stinks. Okay, and then obviously it will help us determine our target areas based on what the higher time frame is doing. Guys, when you read those 4 bullet points, more reliable entry, which means more money, drill down to a lower time frame to get a better entry, which means more money, keeps us out of a bad trade because the higher time frame stinks, which equals saving money, which equals more money. And then it helps us determine our target area, which makes a more reliable exit, which means more money. Guys, this is trading in a nutshell. What can we do to make more money? Okay? And you're going to see on the charts here, these are very real things. This isn't hoopla. You really need to be paying attention to multiple time frame analysis on all and every trade that you take. So let's go through this. Okay? Multiple time frames gives us a look at patterns within a pattern, right? Allowing us to refine our entry points in a shorter time frame when the longer time frame provides the bias. Guys, sometimes you look at something and you go, man, I'd really like to get on that, but I don't see a pattern. And you're looking at the 15-minute. Well, if you drill down to the 2-minute, you might find an entry on that. So it's a pattern within a pattern, okay? You might actually be seeing, for example, let's flip it for a second. You might be seeing a daily breakout. And you're going, well, gosh, that daily breakout looks great, but the stop loss is like $5, which means my risk to reward's okay, but not great. Well, what if I drilled down to maybe a 60-minute or a 15-minute for that daily breakout and was able to get, instead of a $5 stop loss, a $2 stop loss? All of a sudden, you've just automatically increased your risk to reward by 2 to 1, 2.5 to 1. Okay? It's also going to help us determine when a shorter time frame might fail. Okay, you're going to see this in just a few minutes. Okay, it's very important. I'm going to leave it at that on this one. Determine when a longer time frame might fail. Okay, to determine when multiple time frames are in alignment, which obviously increases the likelihood of a trade working. Okay, so guys, what does this do? Why do we look at multiple time frames? To give us more information. What are we always looking for in trading? Most people get this answer wrong when I say, what's the main goal in trading? Other than to make money, obviously, but we're looking for confirmation. We're looking at something and we go, wow, that looks good. Now prove to me it's good. So what do? You go and look at other time frames because those time frames are giving you more information, and more information is either confirming what you already believe, or it's unconfirming, or what's the word I'm looking for? You're basically saying, look, I'm not getting the confirmation I thought that was here. Right? So you want to look at those multiple time frames to get the confirmation. And if you look at multiple time frames and you're not getting confirmation, you don't take the trade. So as it says, multiple time frames provide different pictures which communicate the direction of prices. At times, a different time frame can give that picture. Same picture, which is good, or a different picture, which is not good. So let's take a look at the charts, which is what you guys always want to look at. By the way, guys, little side note topic. Okay, excuse me for my language when I say this, all right, and I mean this to everybody, and I mean this politely. Get your heads out of your asses, okay? Charts are sexy, and people love charts, but you do realize that there's so much more to trading than just looking at charts. Charts are wonderful, but dealing with money management, dealing with emotional discipline and psychology, understanding that your emotions and psychology have a massive impact on the type of trade management that you choose. None of those things have to do with charts. So pull your head out and realize that the charts are the easiest part of this business. I'll repeat this for the people that didn't hear it. Charts are the easiest part of this business. They're also the most attractive part of the business. It's like looking at a Victoria's Secret model. It's shallow and superficial. She might not be a very good person. So you marry her anyway because she's hot. And then you go home and go, my gosh, she's a psycho. That's trading, guys, in a nutshell. You guys all get caught up in the charts because charts are sexy, right? In your mind, charts are dollar signs. The charts aren't the dollar signs. It's the trade management, money management, and psychology that ultimately equal the dollar signs. Okay? I'm telling this to you because, yes, we're about to go over some charts, but you have to understand there's so much more to this business than just looking at a chart. Okay? I get way more questions on charts, way more views on YouTube on charts, and maybe a quarter of the amount when it comes to emotions and psychology and money management and discipline. It's sad, but this is good because many of you will fail because of that, and the other people that are into those things will take your money because you weren't smart enough to do that. You've been warned. Okay, now let's move on. Matching time frames, guys. So what do we have here? What we have here is a 2-minute on MMM, a 5-minute on MMM, and a daily on MMM. So we always start, because we call it the top-down approach, we always start with the higher time frame. Okay. Now, you might actually see the pattern first on the 5-minute, but you still have to go up to the daily. In the pre-market, okay, in the pre-market, we're always looking at the daily first. Why? Because that's how we find stocks. We're scanning daily charts. So 99% of the time, you'll find the pattern on the daily or the 60 first, and then you'll drill down later, which is preferable, okay? So here we have a stage 2 uptrend on MMM. The stock is strong, it's moving higher, and then it moves into a double, triple top stage 3. Stage 3 is that tug of war, back and forth. Buyers and sellers jockeying for position, but nobody's winning. Ultimately, in this case, the sellers win. There was a wide range green bar right here, and we gapped under this. So all the people that bought this stock the previous day are losers today. This is good for you. Why? Because they're going to wake up, utter some 4-letter word and go, I need to get out of this stock. And they sell it and it pushes it lower, and that's what you want. Now, the gaps, how to find gaps, what a good gap is, what a bad gap is, that's a topic for a different discussion, different day. Okay, so we gap down under this green line. The green line is the support area. Once you get under the green line, you have room down to about the bottom of this pivot at roughly, 147. Okay? We drill down, and what do we get? We get a little 5-minute pseudo 3-bar play, which is also a 2-minute breakdown. Entry is 150.150, and the stop loss is 152.25. All right? It doesn't look like much, but it's already dropped $1. Okay, on a 75-cent now. Is that a great risk reward? No, but you can see on the daily chart, where does it ultimately get to? About 147. So this thing's not even close to target. I just happened to take the picture right in the middle of it right there. The point I'm making is you can see on the daily, it did get down another $3. So ultimately, this stock moved about $4 on a 75-cent stop, which is about 5 to 1 on your money, give or take. Okay, how was this made possible? Because the daily gap was gorgeous. It was beautiful. You weren't going to miss this thing today. And then it gave you a beautiful 5-minute 3-bar play that triggered technically right there. And then the breakdown triggered right here. This is multiple time frame analysis. Using the higher and lower time frames to get a quality entry, have a great bearish bias, take advantage of the bearish bias with a beautiful 3-bar play pattern. Okay? Here's another example. The higher time frame strength makes for a more reliable 15-minute entry. So what do we have? We have a stock that's honestly not very nice on the daily chart. It's pretty choppy, right? Moves up, pulls back, moves up, pulls back. It's in a bit of a wide range, about a $10 range. And all in all, it's sloppy. But you have this wide range green bar followed by a narrow range. For those of you out there, no, this is not a buyable 3-bar play. Why? Because there's resistance above. This is not a buyable daily 3-bar play. There is resistance above. So what's our job? We wake up the next day and we're like, this stock would be good if, and what's the if? The if is if it's above $36 or $36.25 or whatever that area is right there with those topping tails. So I really like this idea if it gets above 36. So this wouldn't be a great gapper because it's not a gap. This would just be on your daily watch list on a stock that has a strong buy setup in here, but it still needs to break 36. So your job is to say, all right, I'm going to put this on a watch list and I'm going to put an alert. So when this stock breaks 36 or comes up to 35.75, you want to give yourself a little bit of time, right? So you put an alert on your trading platform, one of those that goes ding, 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 and then you go, oh, XYZ stock is almost above 36 bucks. And then you drill down and see if there's a pattern. There may or may not be a pattern. In this case, there was. You had a wide range igniting bar taking out 35.50. Oh, there's the line taking out 36 and even 36.25. So we're basically taking out this double top pivot. This is where all the sellers are. The last time the stock traded this area, it got smacked. The next time it traded this area, it got smacked. This time, though, it powers through it. And it does so with a beautiful 15-minute 3-bar play triggering just after 10 a.m. Wide bar, narrow bar, rip. Okay? Your entry's like 36.25. Your stop's about 35.80, 35.90, something like that. So you're looking at maybe a 30 or 40 cent stop loss, and this thing went about $1.50, give or take. That's what? 3 to 4 to 1 on your money. It started with the daily breakout, though. Without the daily breakout, you would never take this. If this was happening at 35.50, you wouldn't likely take it because 36 has resistance. So it's a far more reliable entry because the daily is also breaking out while the 15-minute is breaking out. Multiple time frame analysis. Okay. You guys saw this chart. I believe I actually put this in last week's lecture. I think this was in last week's lecture, but it's worthy of putting in this lecture. I really should make this a little bit bigger. Maybe I'll do it while it's here. Let's make this a little bigger. There we go. Give me 1 second, guys, while I move this. There. So now you can see the daily just a little bit bigger. Okay? Anyway, what do we have here? A stock that was looking poised to break out and go higher. The last 4 days, that's exactly what this stock was doing. It kind of stalled at a resistance point on the daily. It gaps down under a bottoming tail, a doji bar, and a green bar. Bottoming tails are very bullish, particularly on this chart. Doji bar is somewhat neutral bullish, and then this wide range green bar is very bullish. What are you doing here? You're taking out buyers. And again, they're going to wake up the next day, utter a 4-letter word, and go, I need to get out of that stock. Because if we're being honest about this, if I bought this stock at 17 or 18 bucks and it was just powering up, you're thinking to yourself, gosh, it might get back to 24. And you wake up the next day and it gaps down $3 against you, 10% or so, whatever. You're not going to be happy. You might just say, you know what? There's no coming back from this. I need to get out of it. So that pushes it lower. So it chops around, guys. This is pre-market, pre-market, pre-market. And then when the market opens, you get this breakdown right here, right there. 1650 with a stop at 17. You can see the entry was called in the room. It was on the favorites list. Made $1,000 off of it. It's all possible, only possible, because of the daily chart. It's only possible because of the daily chart. And then we had a pre-market breakdown, like we did on INTU today, like we had on MU today, like we had on WDC today, etc. and so forth. Okay. Same situation here. Gaps above 2 topping tails, above a pivot, gives you a perfect 4-bar play. That's it. It's money, right? I'm not even going to spend that much time on it. It's really nice. This stock was going to go lower. It was breaking support. It was leaving topping tails. The buyers tried to step up the previous day, and they failed. So you're thinking, well, clearly the stock's probably going to gap down the next day. Nope, it gaps up, takes all these people out, and just rips higher. And there's your entry, 79 bucks. Right above here, you need to be above 78. Well, you're at 79. It's perfection personified. Okay? Same situation here. Gap above a daily pivot. 2 red bars, not too extended. Wait for an entry. You have the gap you want. Now you have to be patient and wait for an entry. Wide bar, narrow bar, rip. You have to be patient and wait for the entry. Okay? If you were patient, well, for me anyway, it made me $1,300 on this particular trade. Now, this is what I like to call the trifecta. Okay? The trifecta is when you can get the higher time frame of the stock to match the lower time frame of the stock, which also matches the direction of the market. Okay? I call it the trifecta. You can call it whatever you want. We're gapping down on the 60-minute, and we can see this blue line here right around 47.75, give or take. There is no more support after this. That's it. Once you break this double bottom support area, there's void below, all of this space to drop into. Okay? Now, you also drill down and go, wow, stock's a little choppy off the open. It bounces, gives you a sell setup, by the way, that was definitely tradable. Pulls back and starts to consolidate. We talked about breakouts and breakdowns last week. Consolidates in a beautiful manner at a whole number, back towards the declining moving average. Is all a recap of last week, okay? With a volume drop, and then when it triggers, tanks. And what's the market doing at the same time? We're looking at an entry here around 11 a.m. What's the market doing right around 11? Guys, what does the market do? The market breaks the low of the day right at 11 a.m. and continues lower. And like I said, it doesn't look like much, but this ultimately went to about 46.30. That's a 70-cent move on an 11-cent stop. 70-cent move on an 11-cent stop. Yes, it took a while. You got your initial move here, which gave you about 30 cents, and then you had to sit around for the most. So you could have sold half, you could have gotten out, or you could have waited for the rest later. This is the trifecta. Market's weak, breaks down when your stock breaks down. This stock, how did we find it? Because the 60-minute. We're going, wow, yes, it's opening at 48, but if it gets below 47.75 with a pattern, we need to find a way in it. You probably would have been in it on the sell setup, and you could have added on the breakdown. And it gave you a 60-minute 3-bar play on top of it. Wide bar, narrow bar, drop. See the 60-minute 3-bar play? It's beautiful, right? It's beautiful. Same deal here. 1-minute breakout. Why was this valid? Why was this doable? Why was this possible? Because of the daily gap. It's gapping over this line, which is like 54, 55 bucks right there. Okay? 9:33 in the morning, JWN 56 by 55.60. I was looking at this as a 3-bar play 2 minutes into the day. It held another 2 more minutes, and then boom, you buy it at 56, your stop's 55.60, and this thing went like $1.75 on a 40-cent stop. So about 4 to 1 on your money. And you could have added on the secondary 3-bar play. What would you have done? You would have added right around 56.70. Your cost average would be 56.35, and you would have raised the stop to right around 56.40. So you would have a break-even stop loss and ride it up another $1, but now you have twice the shares. Right? Now you have double the shares. So you ride it up another $1, you get it out at like 58.35, but it's all free money, right? You could have made 4 or 5 to 1 on that, all right? Now we're going to get into some of the interesting stuff. Now I've just given you the basic, straightforward multiple time frames. You're going, yeah, that's neat, Jared. Sure, start with the daily and drill down to the 2-minute and make it happen. Got it. One, most traders don't do it. They trade in a vacuum nonetheless. But now we're going to start turning things up a little bit and showing you the true value and benefit, okay? Drilling down to a lower time frame to get a better entry. So you see, what we have here on the daily chart on the left is a climactic sell setup, a parabolic sell setup. 1, 2, 3, 4, 5, 6, 7 bars up. And you're going, holy shnikes, this thing is really extended. It went from 55 bucks to 67. It's far from the moving average. Super wide range green bars. Super volume. Guys, when I mean super volume, this one bar did over 20 million shares. Yes, it's a daily chart. So that day, the top is near. The top is near. And you're going, my goodness, I'd love to short this thing back to like 61. 50% retracement, right? I'd love to get into like 66 or 65 and trade it to 61. But if you take the daily chart, you have to get in at like 64.50, and your stop loss has to be above $67, and now you're looking at a $2.50 stop loss, which means your target's got to be at least $5, which puts your target where? 59.50. 59.50 is a bit far away, right? Normally, the climactic target would be a 50% retracement, which is roughly 61, give or take. Okay? Would be a 50% retracement. This retracement down here to 59 is a lot more than that. So you're going, man, the risk reward there is just, So what if you could drill down and get a better entry? And there you go. Right there. Okay? So this thing rips, wide range bars, massive volume. Guys, this is a 2-minute chart, and this stock is doing close to 1 million shares every 2 minutes. I'll repeat that. Every 2 minutes, the stock was doing almost 1 million shares, then 500,000. You get doji bar, topping tail. You're going to get in at 66.50. Your stop's going to be just above 67. Tank. Look at this. How sweet is this? This is possible only because of the daily chart. It makes this trade so much better because it's not just a stock that moved from 64 to 67 anymore. It's a stock that moved from 55 to 67. But if you didn't look at the daily chart, you would have never known that, and you might have thought to yourself, that's not that extended. It's a $60 stock that's up $3. That's not climactic. It's $3 move. It's 5%. That's nothing. And then you look at the daily and go, wow, this stock has just moved $12 in the last 6 days. And on top of it, you get a great entry, far from the moving average. Now, what could you do here? You could trade this as an intraday trade with a 50 or 60 cent stop loss. Get out most of your position, like 3/4 of it. Hold 1/3 or 1/4 for the move down to 61. So what have you done here? You've basically taken an intraday swing trade. So you made money on the intraday. You sold 2/3 of your position. You've locked in however much, 500, 1,000, 2,000 bucks. And you say, you know what? I'm going to hold 1/3 of this thing. I'm going to keep the stop at 67. I'm going to try to get down to 61. I have a great entry at 66.50. So if you took 1,000 shares of this, $500 risk, right? 1,000 shares, and you sold 700 of those shares down here at like 65.50 or 65 bucks, and you made 1,000 bucks, 2-to-1. You made 1,000 bucks. You have 300 shares left over. You can't lose. You can't lose. Because if those 300 shares stop out, it cost you 150 bucks. You've already made 1,000 off the 700 shares. If the 300 shares come all the way back and tag you, you lost 150. So net, you still made $850. But if it keeps going lower and gets down to the 61 area, now you've made $5.50, 66.50 down to 61. 550 times 300 shares is $1,650. Plus the 1,000 you already made, you just made $2,700 bucks. Damn. Right? That's how you drill down to get a better entry, using multiple time frames. Okay? Now, here's another one that's really important. What if we use multiple time frames to help us with our targets? If you trade this 3-bar play in a vacuum, right, you go, wow, beautiful, wide range bar, narrow range bar, drop, 2080 is the entry, 21 is the stop, you got a 20-cent stop loss. How do you know where you're going to get out? You could just take 2-to-1 and walk away, right? You could do that. That's your prerogative. But if you want to really maximize the potential of this trade, you're going to look at the higher time frame. And what do we have? A stock that gaps down, and it's a relatively smooth move up. So the move back down should also be relatively smooth, but it does have a pivot support area in which it bounced before. So when you look at that 1970 area, 1975 area, this is your hard target. Drops, consolidates, drops, guys. As soon as you get into this $19.98, $20, you're going to yourself, we're down a lot. Massive volume spike last week, 2 weeks ago. We talked about volume tells us, price tells us what is happening. Volume tells us how it's happening. You're sitting here with a massive volume spike, very, very close to pivot support after an extended move. Let me repeat that. You have a massive volume spike with a wide range bar at pivot support after an already extended move. It screams reversal. Take the money and run. You've already done well. You've already made 80 cents on this. That's 4-to-1 on your money. Took you like 3 hours to do it, but it's still good money. And you look at the daily and go, man, wide range bar extended into support. It's going to bounce or go sideways. Get out. Don't be greedy. This is where it should pivot and turn back up. You got a perfect entry with a perfect stop. Take the money and run. Higher time frame lets you see that. The higher time frame lets you see that. Here's another example. Now we have a 60-minute chart, which is our higher time frame. So we get a gap up and we're going, wow, this is a relatively smooth pullback, right? From 1140 down to about 1040. It bounces, chops around. But what happens? It gaps up. It gaps up from 1030 to 1080. Now, guys, I want you to imagine for a moment. This was yesterday on the 60-minute chart. I want you to think about it because you should always be thinking about this all of the time. What type of daily bar does this look like? Yesterday, not today's green, yesterday. What type of daily bar would this be? Give you a second to think about it, and then I'm going to give you the answer. If this 60-minute was a daily, it would be 1 bar, right? This 60-minute chart here is 1 full trading day, which means on a daily chart, this would be a topping tail bar. This stock opened at roughly 1060, 1055. It went higher. So it's going green, and then it tanks, which means it goes and eventually becomes a red bar with a topping tail if it were a daily chart. It's a red bar because it closes at the low with half of the bar being a topping tail. Why is this important? It's important because the following day, the stock gaps up over not just the red bar, but the topping tail and the entire pivot at 1070. Do you know what kind of shock value that represents? Wow, like level 1 gap type shock value, the best type of gap you can have. And it's a smooth pullback from 1140 down to 1050. So the move back up should also be equally smooth. So you're gapping over a topping tail red bar. Sellers, sellers, sellers. Nobody thought this thing was going to gap up the next day. So if you shorted this stock and you woke up $1 underwater or 50 cents, you're going to do what? You're going to cover. And when you cover, you buy to cover. And when you buy to cover, you push the stock higher. So what's your job? Your job's to drill down and find an entry pattern. There's 2 of them. There's one here at 1090 right there with a stop at 1080. And there's a prettier one here at $11 with a stop at 1095. Yes, a nickel stop. Yes, I'll repeat, a nickel stop, 5-cent stop. You could use 10 if you want. Wide range bar ignites. Now we've used multiple time frames to enter the trade. Now we're also going to use multiple time frames to exit the trade. Because what's up here? Double top major resistance. This is level 1 resistance, major resistance, double top. Your target is 1140, period. End of discussion. It peekabooed above and went to 1150 and then rolled over. Why? There's resistance there. That's why. So you take the perfect pattern at 11, you get a 5 or a 10-cent stop loss, and you get out at 1140. Why? Because the 60-minute chart tells you this is where sellers are. What happened the last 2 times the stock traded 1140, guys? It got hammered. 1140 down to 1010. Traded up to 1140, got hammered down to 1040. Why would you try to get more than 1140? That's just being greedy and foolish. So you take your, in this case, 8-1 on your money if you used a nickel stop, and 4-1 on your money if you used a 10-cent stop, and you walk away. So this 60-minute chart got you into the trade because of the beautiful gap, and it got you out of the trade at target because of the double top. It doesn't get any better than this. It just doesn't get any better than that, okay? Now, only a couple more few slides left, guys, all right? Bear with me. Now, comparing gaps real quick. I'm not going to get into this, but it relates to multiple time frames. So at Walmart, guys, the stock gaps down near the $70 range. This stock has void below. from 70 down to the gap here around 63. So I don't know what the 2 minute looks like. I don't know what the 5 minute looks like, but this is something that I will keep on my list and wait for a lower time frame entry, because this gap has tradable void, right? So I don't know if it's going to give me a 5 minute entry or two. I don't know that, but I'm going to put it on my list and I'm going to watch it. I'm going to stare at it until it gives me an entry. It may never, but I know it has room to trade. Tesla, on the other hand, is third day down, technically really second day down, right? Wide bar, gaps down. Where is it gapping to? It's gapping right to 201. What is that 201? A pivot support area where buyers came in previously. I'm not going to put this on my watch list. Why? It's gapping right to where your target would be. If this thing gapped to like 207, you might trade it and go, well, it's got room to 201, but it gapped to your target. It's gone. It's dead to me. Doesn't get the preferred treatment. I delete this from my list and I keep Walmart. It's that simple. Okay? Now, this slide is next level shit. Okay? I really hesitated to put this in here. I really did. The reason I hesitated to put this in here is this is a direct slide out of Professional Trading Strategies, and I think it's one of the better slides in the entire book. It's 525 pages, and this is one of the best slides in the whole book, okay? Because it gets traders to think outside the box in ways in which they rarely ever think, okay? Everybody is just so concerned about what's right in front of them that they're unwilling to look behind them sometimes or next to them. So the higher time frame keeps us safe. Let's say we're vacuum trading, okay? We're going to vacuum trade, which is not what we want to do. So we're just going to look at the 2 minute chart and we're going to bear down. All right? So let's explain. Let's go over this. So we have a small gap up. Ignore the 15 minute. In fact, put a piece of paper over this. All right? I should probably cover it with a piece of paper. Okay? Ignore this. This stock goes up, chops around, retests the high, and fails. Now, we have stage 1, stage 2, stage 3, and stage 4. For those of you that are live traders, you understand the market cycles. We have 4 stages. Okay? On a micro time frame, this stock is in a stage 2 uptrend with a stage 3 double top retest and failure that moves into an early stage 4 downtrend. Okay? Multiple lower highs and lower lows. So you could make the strong argument that this is a good sell setup. If you remember, we're trading in a vacuum because we're stupid and we're not looking at anything else. So we're just focused on what's standing in front of us. Okay? Stage 2 uptrend, double top, stage 3 retest and failure, drops into an early stage 4, stock drops under support, bounces, goes lower, and bounces. What do we have? A 2 minute sell setup. SS is sell setup. What do we have on the sell setup? We have a topping tail, we have a doji bar, we have a declining moving average, we have a 50% retracement. What we have here is a lot of very positive, high quality attributes to justify taking this sell setup. So we're trading in a vacuum. Don't look over here. Don't do it. We're trading in a vacuum right now. And your guys are going lower high, lower low, lower low, possibly lower high. That's 2 or more lower highs and lower lows equals a downtrend. And I'm getting a topping tail. And it's below the moving average. And it's at a 50% retracement. And it's got a doji bar and a narrow body bar. I'm just racking up all the reasons to trade this stock. I'm just racking them up. So many reasons to take this trade. And then you take it, drops a few pennies, whatever, 50 cents, and then rolls over. And you sit there and you scratch your head and you go, I did everything by the book. I have my PTS book right in front of me, and Jared says, multiple lower highs and lower lows, 2 or more, get yourself a 50% retracement, get it below the moving average with a topping tail, with a red bar, with a doji bar, with a narrow body bar, all of those things, and it didn't work. Maybe he's a bad teacher. Maybe PTS doesn't work. Maybe technicals are wrong. You traded in a vacuum. What happened here was you took a sell setup that was against the higher time frame trend. The higher time frame was setting up a buy setup. So the failure of the 2-minute sell setup is confirming the 15-minute buy setup. So the trader who's on the 15-minute chart, who's using multiple time frames, is saying to themselves, and I quote, the nanosecond that this 2-minute sell setup fails, I'm going to buy this stock on the 15 and put my stop loss under here. If this sell setup keeps going lower, then no harm, no foul, because I'm not in it. But the second that this stock trades above that pivot on the 2-minute, I'm going long. Why? Because going long triggers the buy setup on the higher time frame. Guys, just in case you're newer to trading, the higher time frame is always more relevant than the lower time frame. Why? Because it's been happening for a longer period of time, which means there's more volume in the higher time frame and there's more commitment in the higher time frame. So the higher time frame is always more valid than the lower time frame. So the failure of the 2-minute sell setup is what is confirming the 15-minute buy setup. This failure makes this buy setup better. And here all along, you're sitting here wondering why the 2-minute sell setup failed. Because you weren't smart enough to look at the higher time frame. So in this case, looking at the higher time frame kept us out of the 2-minute sell setup. And not only did it keep us out of the sell setup, it gave us a really good trade. So as a rule, the failure of the lower time frame pattern will signal our entry on the higher time frame. It's next level stuff, and I'd venture to guess there's never been another person that you've learned from in trading that's ever covered this specific topic with you. I could be wrong on that. Okay? So don't trade in a vacuum. Do not do it. And then one last slide. And that slide just happens to be from today. It's the only reason I'm putting it on here is because it's from today. 2 comments I want to make on this slide. 1, this stuff happens every single day, guys. The only difference is whether or not we find it. I'll repeat what I said because it's important, because I'm tired of getting emails or YouTube comments from people where they say, Jared, your 3-bar play video is awesome, but I haven't found one yet. Well, then you're not looking. Jared, your breakout video is great, but I never find breakouts. You're not looking. Okay? Jared, I can never get the daily and the 2-minute to match timeframes. Then you're not looking. Okay? Guys, today we had tons of that stuff happen, from WDC to Coop to ATVI to MU to Intel. Half our damn gap list had multiple time frame analysis today. So what do we have here? We have a gap up on Intel, over a topping tail, a red bar, and right here. Relatively smooth pullback equals a relatively smooth move back up. So guys, this basically is like 47.70 or something like that. I'm serious. It's like 47.79 or 47.70, this red line. Room back to 53. What does Intel give us? Wide range bar. You get a 3-bar play and it rests for just a little longer. It's still valid though. And you got a secondary 3-bar play right after it. Your entry is 47.80, 47.82, whatever. Your stop loss is like 47.70. Sure, it only went up 60 cents, but it was only like a 15-cent stop. It's 4-1 on your money. It happened today. Today. Right? And we see that every day. So I'm only putting this one in here because it confirms that multiple time frame analysis happens every day. It's whether or not you find it every day and whether you have the stones to push the button to take the trade. Okay? So this brings me back to one last summary. Okay? This. The 4 main reasons to use this. More reliable entries by using a higher time frame as confirmation. Drill down to a lower time frame to hop on a trending stock. Remember we saw the climactic example? To keep us out of a bad trade due to issues with the higher time frame, which was also what we just talked about with the 2-minute sell setup, and to help us determine target areas based on the higher time frame. We saw that also. These are the reasons. Could you have better reasons than that? No. So you can see just how important this specific topic really is. Multiple time frames make your trades better. Once in a while, you get away with trading in a vacuum, but as a long-term approach, it's silly, it's foolish, and it's just straight dumb. Okay? So multiple time frame analysis, guys, it helps keep you safe, helps determine where target areas are, helps get you better entries. There's just so much quality to using multiple time frame analysis. Okay? So that'll do it for the multiple time frame analysis lecture. I hope you guys enjoyed it. If you have any questions, I will stick around for a few minutes to answer them. But that will do it for this week's lecture on multiple time frame analysis.
To get more great educational content, subscribe to the Live Traders YouTube channel. This way you'll get email alerts every time I upload a new video.